Hello and welcome to the BamCam podcast with your hosts, Jack Burnette and Adrian Castellano. I'm Wendy McConnell. Well, where is she? Where is Alison? We don't like doing this without Alison.
Well, she's actually in a room just outside the podcast studio, meeting with someone else, part of our tech team here at RFG Advisory. So she's in good hands.
We're working on many important projects right now. We are busy juggling.
All right. So it's just going to be you two today. I'm curious to see how it goes without Alison keeping you guys in line.
We may be in trouble.
Yeah. As a matter of fact, I am not sure. I can't remember a podcast episode that Alison was not on. We'd have to probably go back through all the episodes.
I don't think there is one.
Yeah.
There may not be.
So let's not let this be the best one we've ever done.
I find that's going to be hard to believe.
Oh, never come back.
Would her job be in jeopardy?
She would never come back.
No,
wow.
Stop.
She's going to kill us. She's going to kill us for this intro.
Yes.
Alison, we need you. Okay, guys, what do we have on tap for today?
So, Wendy, we're talking today about something that gets a lot of buzz this time of the year. It's something called the Santa Claus Rally, right?
Ooh.
If you follow the markets, you've probably heard this phrase tossed around a bit, but what does it actually mean? Is it just holiday folklore, or does Santa really have a sleigh full of stock market returns?
Yeah, it's one of those fun conversations that, if you watch CNBC or Fox Business, they'll talk about it here over the coming weeks during the holiday season, and where they mix finance with a little bit of festive cheer. So Merry Christmas, Happy Holidays, Happy Hanukkah.
Let's talk money.
It's a Festivus miracle.
Yeah.
So anyway, we're going to start with the basics. What is the Santa Claus Rally that they may talk about, that you may hear about or read about? The Santa Claus Rally really refers specifically to a 7-day trading period. Remember, the markets trade Monday through Friday, so it's basically 5 days a week, except for holidays. And it includes the last 5 trading days of December and the first 2 trading days in the new year. Since 1950, this is really interesting. This short window has seen a remarkably consistent increase of 79% of the time.
Yeah.
And an average gain of 1.3%. So you think about it, 1.3% in a 7-day period.
That's substantial.
It's pretty substantial.
Yeah, it's incredible. And that's what's fun about this. It's not just a one-off, a fluke. It's shown up kind of over and over again through the decades. But why, right? Why is that? There's no single proven cause for the Santa Claus Rally, but decades.
Festivus miracle.
Yeah, that's the simple way to put it. But decades of market research point to kind of a combination of psychological, structural, and calendar-driven factors that tend to converge during that last week of the year and then into the very beginning of the new year.
Yeah, when you peel the onion back, there are some logical reasons for this. So before we get into understanding why, let's talk a little bit about the history of this. The term Santa Claus Rally has been around for decades, really since the 1970s, when analysts started noticing this repeatable uptick in stocks or equities in the final week of December, in the first couple of days of January. And then a market historian and the founder of the Stock Traders Almanac, a fellow by the name of Yale Hirsch, popularized that term when he saw this pattern happening over and over again. And he noticed those final trading days of the year when trading volume is low, investor sentiment is high, and that it often brought kind of a surprising uptick in the market.
Yeah. So that's what's kind of cool about Hirsch's story here is just how far ahead of his time he really was, right? He was a pioneer in market seasonality and investor behavior far before behavioral finance was really even a thing. Today, we talk about these kinds of things like investor psychology and sentiment all the time, but he was already connecting those dots 50 some years ago.
Yeah. So,
yeah.
So, we talk about why it happens. It comes down to really three things, and that's psychology, timing, and cash flow, money flow.
Yeah.
First, the psychology part. Typically, most people are somewhat happy and optimistic during the holidays.
Jolly.
They're
a little more jolly.
They're jolly. And, you hear me talk about this Festivus reference. Most people that know me well know I'm a Seinfeld aficionado. So if you don't understand what I'm talking about, then you have not seen a lot of Seinfeld episodes.
Jack lives in Seinfeld references.
So anyway, that's what that is. But the holidays are an optimistic time. Mm-hmm. Investor sentiment gets a little jolt of holiday cheer. Maybe it's the eggnog.
Maybe it is. It's a little too much eggnog doing its trick. Yeah, the Santa Claus Rally, it's really one of those moments where you can see that investor sentiment at work. And what is investor sentiment? It just means the overall mood of the market, how confident or fearful investors feel. And kind of like we alluded to around the holidays, that mood starts to shift. People tend to be more optimistic, grateful, forward-looking into the new year. They're thinking about setting new goals. Again, they're feeling hopeful. That mindset affects how they handle their money. And when investors feel confident, they're more likely to buy rather than sell. They're also more willing, perhaps, to take on a little more risk. And all that extra buying activity, it tends to nudge the market upward.
Yeah. So the markets, just like people, kind of tend to feed off of motion. That's often why we often see when markets move up, they overshoot. And when markets move down, they overshoot a little bit. So it's that momentum that feeds off of that emotion. But that optimism is contagious. So let's talk about the timing part. And what that really means is when this actually happens.
Yeah. So remember, we said that the Santa Claus Rally, it takes over those 7 trading days, the last 5 of December, the first 2 of January. That's an unusual stretch in our personal calendars. There's a lot going on, right? But it also sits between the 2 big holidays. You've got Christmas and you have New Year's. And also between 2 big forces, the end of one tax year and the start of another.
Right. And interestingly, during that time, most of the professional investors, and the institutional money managers and that sort of thing, they're on vacation.
Yeah, exactly.
They're skiing in Aspen, and all those rich people are skiing in Aspen and Vail, and everything. So they're off skiing, and so they're taking that time off, and so with fewer institutional players in the mix, you have very low trading volume, and that means that smaller purchases or momentum of purchases carry more weight.
Yes,
it has a bigger impact in the market. Yeah. Remember, at the end of the day, if the market goes up or down in a given day or week, it really is simple as there's more buyers than sellers.
Exactly. Yeah. So if investors are feeling optimistic, right? Maybe they've received their year-end bonuses. They're happy. They're in good spirits. They're repositioning their portfolios. Maybe they had a little too much eggnog. Those small bursts of buying, they get amplified. And that's part of, like we mentioned, the timing magic that's behind this so-called Santa Claus Rally.
Yeah. So the psychology and timing go hand in hand. You've got optimism up, but it shows up at the same exact time that the market is relatively quiet.
Yeah.
So, and that creates the perfect window for prices to drift up with not a whole lot of resistance. And then here's another timing issue or phenomenon. Prior to the Santa Claus Rally period, most professional money managers do what's called tax loss harvesting. And that's where for tax purposes, you're kind of tweaking the portfolio to capture any tax losses for strategic tax planning purposes. So that means most people that are managing money do that earlier in December. So that selling of position is done to offset capital gains. Generally, that's done, in the weeks leading up to the Santa Claus Rally. So once that's done and those trades settle, often many money managers are buying back some of those same positions that they've captured those losses on. So that's another reason why you may have some purchasing that's occurring during the Santa Claus Rally.
And so maybe making reference back to my former industry, meteorology, it's like a tornado forecast. You have to have all the ingredients come together perfectly at the right time in order for that tornado to form. Or maybe we talk about a snow forecast for the snow to happen, especially here in Alabama.
Well, that's a crapshoot.
Everything needs to be perfect. If something's off just a little bit, it doesn't work. But that's kind of what is at play here with the Santa Claus Rally. Just all these ingredients coming together to kind of fuel that rally. All this is to remind you that markets, they have seasons. Like everything else, there's times of optimism, times of caution. And this late December stretch happens to be, like I mentioned, when that confidence and timing overlap, right? It's less about chasing a rally and more about understanding how human timing, how we behave, how we plan, how we close out a year, all that can show up in the markets too.
Right. So the final piece of the why is money flow. You've got the psychology and the timing that is kind of lining up on our forecast, but ultimately it's money that you have to buy stock at that point. And you have an influx of money that takes place late in the year. People receive holiday bonuses. Companies also are making retirement plan contributions at the end of the year and quarterly. So that's another influx of money into the market. And then investors are finishing up tax-related moves, rebalancing portfolios and things of that nature. So it brings fresh money into the market. Yeah. Again, more buyers than sellers during this 7-day trading period.
Yeah. And if you think about it, December and early January, it's like a financial reset button for a lot of people. You combine that new, fresh money with a positive mood and fewer sellers, the trade volume going down. You can see why the prices might get a nice little lift.
Yeah. And, speaking of rebalancing, that's another interesting part of the story. Professional money managers, professional investors, pension funds, mutual funds, endowments, those types of money managers all go through a process of rebalancing their portfolios. It's, when stocks have done well in a given year, they might sell a little bit of their equity holdings and buy more bonds or cash to get back into their target mix. But before that happens, there's often an initial wave of buying to finish out their positions or window dress their portfolios for year end. Mutual funds, for example, report their holdings quarterly. Mm-hmm. So kind of imagine this: you're a mutual fund manager, and you do not have a popular stock, right? I'll pick NVIDIA right now. It's a really popular stock. It's done very, very well over the last couple of years. And you don't have NVIDIA in your top 10 holdings. It's sitting there rated, at number 15 in your holdings. It's in the portfolio, but it's just not there.
Yeah.
You might have a desire to put it in your top 10 so that you don't look like you're missing out on the NVIDIA craze. Mm-hmm. So that window dressing, as they call it, can come about where managers may be wanting to invest in the market to clean up their portfolio so they look maybe better than they actually are.
Yeah, right there at quarter ends.
So it's all about the show.
Yeah, all about the show. Isn't that like that way in a lot of industry?
Yeah. So what you may have is many money managers at once trying to clean up their portfolio here right at the end of the quarter.
Yeah, exactly. So to kind of recap here, that money flow story, it goes a little like this. You have the bonuses and the retirement contributions, adding that new fresh cash into the equation. You have investors rebalancing or reinvesting for the new year, perhaps with new goals, things like that. Fund managers, they're cleaning up their portfolios for reporting. And like we talked about earlier, the lower trading volume can amplify all of this, every single move. So the Santa Claus Rally, it's not magic. It's just money moving at the right time, in the right direction, in the right way to cause this rally. It's the perfect mix of emotion, timing, and money all wrapped up in a festive little bow.
In a bow.
With a kind of funny name.
Yeah.
You know?
Yeah. That brings us to a very important point.
Mm-hmm.
The Santa Claus Rally is very fun to talk about. It's interesting to observe and see. That the data is fascinating, but it's not necessarily a strategy to chase. I'm sure there probably are some people that do some arbitrage management that's trying to chase that small little return. And even though it's been remarkably consistent, it's not guaranteed. It doesn't happen every year. About 1 out of 5 years, it doesn't happen. And so it's not something that you want to incorporate into a strategy. It's more of an interesting thing to observe and fun to talk about.
You can talk about it at the dinner table Christmas Day.
And wow your family members. as you're referring Eater Financial Wellness to your friends and family.
Yeah. And then they'll do a little research and say, wow, this guy knows what he's talking about, right?
Let's hope.
The more you try to time the market, like Jack mentioned, the more likely you're going to miss the bigger picture. We talk about this on so many of our podcast episodes. It's the steady long-term growth that can happen when you just stay invested and let your plan work that really does the magic. In our industry, that's why you hear people say, it's not about timing the market. It's about time spent in the market.
Absolutely. If you're already investing regularly, if you're clients of ours, you are, and whether that's through your 401k, IRA, or your accounts with us, you're already in a position to benefit from the Santa Claus Rally. And so sit back and enjoy it. Because you don't need to chase it. You're already part of it.
Yeah.
And just sit back and enjoy your eggnog and sit there and say, and now you understand a little bit of, you don't have to have the smart aleck answer as to, if somebody asks you, well, why did the market go up today? You don't have to just be as flippant as saying, well, more buyers than sellers, duh. You can sit there and say, it's the Santa Claus Rally, and then repeat some of the things you've learned from us on this podcast, and you will totally impress whoever you're talking to.
Yeah, so to tie this all back to investor sentiment, the Santa Claus Rally, it's a reminder that optimism and confidence can drive the market higher. But remember, emotions work both ways. That same optimism that fuels rallies can also turn into fear during the downturns. So if you keep your emotions steady and consistent, you're already ahead of most investors that have a tough time doing that.
Yeah. So instead of, getting caught up in all the headlines to see if Santa Claus does show up in your Wall Street, use this time to, reflect on things that may be more important and more meaningful, and kind of assess your position on your own financial wellness journey.
Yeah, as you come up on the end of the year, take advantage of this time to check in on a few things. Are you still on track with your financial goals? Are your investments aligned with not only your time horizon, but also your comfort level, your level of risk? Are you putting your money toward what truly matters to your family? The end of the year, it's a perfect time to review your plan, celebrate progress, and make small adjustments. And if you need help with any of those questions to see if you're on track, that's where we're here to help.
Absolutely. So, markets may have their seasons and we do too, but at the end of the day, it's discipline, consistency, and your time in the market is how you build wealth.
That's really what's most
important. And that's actually a very boring story, but it is time and discipline will be your best friends in order to build your wealth and achieve your goals.
Exactly.
So with that, we want to wish everyone a very Merry Christmas and hope that you and your families have a wonderful time. Please take these notes and wow your family and tell them about us here at Eater Financial Wellness and how we may be able to help you and them as well.
And take it easy on the eggnog.
Oh, yeah.
Well, sometimes it's called for when you're with family. Adrian, how do we get in touch with both of you guys?
Yeah, you can contact us by emailing info@eaterfw.com. And we'd also love for you to check out our website. That's eaterfw.com.
All right. Well, thanks so much, guys. I appreciate it. Happy holidays back to you. Merry Christmas. Happy Festivus. All of that stuff. I know exactly.
Absolutely. Check on me, Wendy. We'll be doing the feats of strength. And airing of grievances.
The airing of grievances, of course. That's the best part, right? All right. Well, thank you again, and thank you for listening today. Please like, follow, and share this podcast with your friends. Until next time, I'm Wendy McConnell.
Thank you for listening to the BamCam podcast with Jack Burnette and Alison Castellano from Eater Financial Wellness, a financial advisory practice at RFG Advisory. To get in touch with us, visit today's show notes or go to our website at www.eaterfinancialwellness.com. That's ITER financialwellness.com. And please click the follow button to be notified when new episodes become available.
Content here is for illustrative purposes and general information only. It is not legal, tax, or individualized financial advice, nor is it a recommendation to buy, sell, or hold any specific security or engage in any specific trading strategy. Information here may be provided in part by third-party sources. These sources are generally deemed to be reliable. However, neither our guests nor RFG Advisory guarantee the accuracy of third-party sources. The views expressed here are those of our guest. They do not necessarily represent those of RFG Advisory, its employees, or its clients. This commentary should not be regarded as a description of advisory services provided by RFG Advisory or performance returns of any client. The views reflected in the commentary are subject to change at any time without notice. Securities offered by registered representatives of Private Client Services, member FINRA SIPC. Advisory services offered by investment advisory representatives of RFG Advisory, LLC, RFG Advisory or RFG, a registered investment advisor. Private Client Services and RFG Advisory are unaffiliated entities. Advisory services are only offered to clients or prospective clients where RFG Advisory and its representatives are properly licensed or exempt from licensure. No advisory services may be rendered by RFG Advisory unless a client agreement is in place. RFG Advisory is an SEC-registered investment advisor. SEC registration does not constitute an endorsement of RFG by the Commission, nor does it indicate that RFG or any associated investment advisory representative has attained a particular level of skill or ability.